So, Michael, thanks for joining us. Now, it must be nice as CFO to be announcing a buyback alongside the FY21 result today. So, perhaps you can give us a feel for the thinking behind that capital return and just capital levels and generation more broadly.
Yeah, look, and thanks for having me. Look, we're really pleased that we're in a strong capital position, to be able to contemplate returning capital to shareholders. So when we think about our results this year, so strong growth in cash earnings, a relatively positive economic outlook, and the level of capital that we have above APRA's unquestionably strong benchmark of 10.5%, it puts us in a position, or puts the board in a position to consider returning cash to shareholders, both through the buyback and through the dividend. So that's put us in that position that we're able to do that today.
On expenses, it's obviously a pretty topical issue in the industry. And at the first half, the bank announced a pretty significant cost reset, and you've been leading a lot of that work. At the time, the bank did guide to some higher costs in FY21, which have come through. So perhaps you can walk us through what happened in the second half.
Yeah, certainly. As we indicated at the first half, we have a real priority this half to increase our spend on fixed, to do the work we need to do now to set us up for the future. So that's been the key driver of cost increase in the half. So we've invested for fix. We've put on more workforce to get through the work we need to do now. In addition, historically, our investment spend is higher in the second half than the first half, and that's played out again this year. And also, probably one of the new aspects is that with the COVID lockdowns, fewer people have taken annual leave, and as a result, our annual leave liability is built up. So we expect that to normalise, obviously, as the economy gets back to normal.
The cost target, it's 8 billion by 2024. Do you think that might have gotten a little bit harder given it, you're coming off a higher starting base?
As I indicated, we expected to have a higher cost base in FY21 for the addition of the fixed work we needed to do, and the plans that we have in place to get to our $8 billion cost base remain relevant and are appropriate. So we have clear plans over the next 3 years to deliver that cost base, and so that hasn't changed. So everything is as we expected, and we're on that trajectory for that lower cost base in 2024.
And margins, they're also in focus for the industry. I'm interested if you can give us your take on the margin performance in the year, and also just the outlook, given all the moving parts, such as pretty hot competition for lending and also a pretty dynamic environment for funding costs.
As we think about margins in the second half, obviously the competition for the mortgage business, competition in business lending has been really strong. So that's had an impact on margins. And low interest rates generally, and I think I've said this before, aren't good for banks. And so the low interest rates and the competition has been the big driver. And what we saw in the first half was the benefit of the repricing of deposits. And we didn't have such a big opportunity to reprice deposits in the second half. So that was why the margin compression was higher. And also some of the things that went in our favour is continuing low wholesale funding costs were to our benefit.
And the rising rate environment, markets around the world are getting pretty excited about the prospect of inflation and rates actually rising for the first time in many years. Do you think that could be a positive?
Yeah, look, I think it will be. So, we do expect rates to rise. I think the big question at the moment is when will that be? We've got the RBA that's indicated that rates won't rise till 2024. We've got Bill Evans, who's obviously a highly respected economist, saying 2023, but we've got the market betting 2022. So I'm not going to pick when it'll happen, but yes, I think we'll acknowledge that rates will rise, and in the longer term, that will be of a benefit to the bank.
And if we turn to lending dynamics, are you pretty pleased with what you're seeing in terms of the continued performance in improved mortgage growth, but perhaps it can start to come through in business lending soon too?
Yeah, we're really pleased with where we've got to in mortgage lending, but also in the early signs for business lending. I think we've said, certainly at the full year last year and at the half, that mortgages was a real focus and priority for the bank and for the CEO. And we've done a lot of things over that period of time. So we've now got our mortgage origination platform in production and operating for all our Westpac brands. We've got business lending starting to see a turnaround. We saw early signs of growth this half, and so that's really pleasing for us. We still think there's more to do, and the teams, both the business lending and the mortgage teams, have a lot of process improvements that they're working through. So we think that will get better and will sustain the momentum that we've established.
Now, despite the lockdowns in recent months, credit quality has again been a highlight. It's actually pretty remarkable what's happening across the industry there. Do you think that can continue to be a tailwind?
Yeah, clearly the economic situation is a lot better than we thought in coming into FY20. So the economy has rebounded much better, even though GDP growth will be down in the last quarter because of the last set of lockdowns, and particularly in New South Wales and Victoria. We expect a rapid turnaround, a rapid sort of rebound out of that, and we'll see some good growth off the back of that. So I think certainly the trajectory is positive and a lot better than we thought this time last year.
And we did see that impairment benefit come through.
Yeah, that's obviously flown through to impairments. We've seen customers that have come through, particularly the level of COVID deferrals pretty well. You might recall that in last year the COVID deferrals were about $55 billion. It's about 10% of that at the moment. So I think broadly both consumers and business have weathered COVID deferrals well, and therefore we're not really seeing any significant deterioration in the portfolio. In fact, we're seeing a lot of pockets of better performance, and that's obviously flowed through to better credit impairments.
And just lastly, you mentioned the better economic environment. Total provisions, they have come down. Do you think that will continue, or are you going to remain quite cautious because there are still these pockets of stress out there?
Yeah, look, we are still cautious. We haven't seen the full opening up of the economy, and that will still progress, hopefully over the next month or two. But so there is a level of uncertainty, and we'll see where it is. But at this point, we really are still quite positive, and we don't see any particular concerns going into 2022.
Well, Michael, thanks for your time.
Thanks for having me.